If you look past the daily headlines, you will see a fundamental shift in the mechanics of the U.S. economy. We are witnessing a synchronized alignment between federal policy and industrial capability that is rare in modern history. The administration's recent moves, specifically the AI Action Plan and the sweeping deregulation of the energy sector, are not just political talking points. They are effectively lowering the cost of capital and the cost of operations for the entire American technology stack. For the observant investor, this creates a landscape where the winners are defined not by speculation, but by their structural position within this new American AI ecosystem. The first pillar of this shift is the reimagining of trade barriers. The headlines scream about a 25% tariff on semiconductors, which sounds inflationary. However, the balance sheet reality is different due to the strategic exemptions granted to U.S. hyperscalers. By allowing companies like Amazon, Google, and Microsoft to import AI chips duty-free tied specifically to their domestic investment, the administration has effectively created a subsidy for U.S. AI dominance. This policy preserves the purchasing power of American big tech, ensuring that their hundreds of billions in capital expenditures translate directly into compute capacity rather than tax receipts. It is a state-sponsored moat that protects the margins of the U.S. technology giants while incentivizing the onshoring of manufacturing. This brings us to the physical foundation of this ecosystem, Micron technology. The market often treats memory as a commodity, but the current cycle is driven by a phenomenon known as silicon intensity. The production of high-bandwidth memory, or HBM, is physically demanding. It consumes approximately 3 times the wafer capacity of standard DDR5 memory. This creates a zero-sum game in manufacturing. Every wafer allocated to AI memory is one less wafer for standard computer memory. This wafer displacement has created a structural supply shock. Micron's position is unique because it is the only U.S.-based manufacturer capable of meeting this demand. With its entire 2026 HBM supply already allocated and sold out, Micron has secured a level of revenue visibility that is uncommon in the semiconductor industry. Furthermore, the company's aggressive expansion in Idaho and New York is directly aligned with federal incentives, allowing it to expand capacity while shielding its margins. The bullish case for Micron, which sees price targets reaching $500, is not based on a temporary spike in demand, but on this structural scarcity where the U.S. supplier holds the pricing power. While memory handles the speed of AI, the sheer volume of data requires a different solution, and this is where Western Digital has emerged as a critical beneficiary. Following its strategic split, Western Digital has become a pure-play entity focused on the economics of mass storage. The AI revolution is generating data lakes of unprecedented size petabytes of training data that must be stored cost-effectively. The math here is simple but powerful. Solid-state drives SSDs are fast, but they are expensive. Hard disk drives HDDs offer a cost advantage of roughly 5 to 10 times per terabyte compared to flash storage. For an AI company training a massive model, using all flash storage is financially unsustainable. This economic reality forces a tiered storage architecture where HDDs remain the backbone. Western Digital's roadmap to 100 terabyte drives, powered by proprietary technologies like UltraSMR and HAMR, directly addresses this need for density. The company's recent financial results, showing a 210% surge in net income, validate the thesis that the storage supercycle is underway, driven by the physical constraints of data center economics. Finally, none of this digital infrastructure can function without power. This is where the third pillar, energy deregulation, comes into play. The administration's move to repeal the 2009 EPA endangerment finding is a significant macroeconomic event. By removing the legal basis for strict greenhouse gas regulations, the federal government is effectively extending the lifespan of existing baseload power generation and lowering the barrier to entry for new natural gas facilities. For the data center industry, energy is the single largest operating expense. A regulatory environment that increases the supply of cheap, reliable power acts as a direct margin booster for AI operators. This creates a favorable environment for the U.S. energy XLE and utilities XLU sectors. Companies that own power generation assets or manage the grid infrastructure are seeing a re-rating of their value. The Deregulation initiative, which claims to save the economy $1.3 trillion in compliance costs, effectively transfers wealth from regulatory compliance budgets back to corporate free cash flow. In summary, the current market environment is defined by a U.S. first integrated stack. Policy protects the hyperscaler's capital efficiency. Micron provides the essential, scarce memory. Western Digital creates the economic storage layer, and a deregulated energy sector provides the fuel. Understanding these interdependencies allows us to see the market not as a collection of random tickers, but as a cohesive machine built for American industrial acceleration. Before we finish, please remember all investments involve risk, including the loss of principal. This content is for educational purposes only and should not be considered financial advice. Please do your own research or consult a certified financial advisor. If you found this analysis helpful, please like this video and subscribe to the channel for more updates on the market's hidden mechanics. I'm Wilson. See you next time.